Okay, so something that my AP microeconomics teacher in high school always said was the rich get richer. And I kind of was like, okay, yeah, cool, but like I'm not rich, so why do I care? Rich, like velocity, is a relative term. Me, just like this average, just college student, I'm used to maybe making like $2,000 or $3,000 a year working at McDonald's or something. But compared to a vast majority of the world, that is like more than they'll ever see in their lifetime. I don't know if that's an exact stat, but you get the point. Now, how does this happen? Investments. This is what this series is going to do. I am going to be teaching people how I invest on Robinhood and how you can do it too and start taking control of your financial situation. Throughout this series, I'm going to try to go from $100 to $10,000. And stocks make a yearly return of about 10%. So if you paid attention in your high school algebra class, you would know that if I want to do that, just trading basic stocks, that will take me about 42 years to complete. Yeah, no, I'm not waiting 42 years to turn $100 into $10,000. That is way too long for me. How do I do this then? Options. And that is what the majority of the series will be talking about, trading options on Robinhood, and I'm going to teach you the ways. Okay, so step number one on this options trading adventure to become rich is downloading Robinhood. Robinhood is a free-to-use app, and if you use the link down in the description, I'll try to get it on the screen here or something, but it'll be down in the description. Just click the link, and just for signing up, Robinhood will give you a free stock that could be valued up to like $500. So that's nice. Free money is always nice. So go ahead, click the link, and get Robinhood. But before we talk about how you actually trade options on Robinhood, we might as well figure out what exactly an option is in the first place. Okay, so when you are trading an option, you are trading the rights to sell or buy 100 shares of the stock for a predetermined price. There are two types of options. Calls, which are bullish, where you want the stock to go up past this predetermined price, so you could potentially buy the stock for a price lower than the actual share price. Puts, which are bearish, where you want the stocks to go down, where you could potentially sell the stock for more than it's actually worth at that given moment. Now, in order to understand options, there are 5 things that you got to understand, and that's the market/share price, the strike price, the expiration date, the premium of the option, and the Greeks. The Greeks are a little bit more complex. I'll talk about them briefly in this video. I'll get into them more in depth in a different video later. The market price or share price is the easiest thing to understand of all of these because it's simply just the price that the current stock is trading at. And to find this on Robinhood, you just search up the stock that you're looking for, click on it, and it'll be right there in the top left corner. So obviously the market price is a really basic investing term. But you're going to have to keep track of that when you're trading your options because your options are dependent on that market price, right? So before we get into the terms that are more niche to options, you're going to want to make sure that options are actually activated on your Robinhood account. In order to do that, you're going to have to go to your profile, scroll down to where it says investing, and then scroll down a little bit more. Now where it says enable spreads on my screen here, it should say something like enable options. Just click on that, answer the questions, and when you're done, you'll see the check marks like they have there on my screen. So in order to actually trade options, you're going to want to go to a certain stock that you want to trade the option for. Go to the bottom right-hand corner and click on the button that says trade. Then go to trade options, and it'll bring you to this screen that shows you just like a bunch of different dates up at the top and then the stuff down below. Just clicking on a random date here, you can see a scrollable list showing you a bunch of different options that you can buy here. Right now I have it on the buy call option, so that means I want the stock to go up. So right now you can see here the share price. Anything that is above this line here that says share price, that's called out of the money. Anything that's below the share price there, that's called in the money. Now just going to a random option here, this $280 call, you see multiple things here. It says buy Apple $280 call March 6th. The $280 part where it says $280, that's called the strike price. Now for a call, you want the share price to get at or above that by the expiration date. The option is good until the expiration date, and if the share price goes above or at or above the strike price before the operation date, putting that option in the money, it won't expire, and you'll be able to buy Apple stock for whatever that strike price is, no matter how much higher the share price is. If you're unlucky and make a bad call and the share price is below the strike price at the expiration date, then your option is going to expire worthless and you're going to lose all the money that you put in that investment. Now, for puts, it's the opposite. If I go over to puts, anything above the share price, that's in the money, and anything below the share price, that's out of the money. Now, going to a random put here, it's the same thing where it says $275 put. That's the strike price, and it expires on March 6th. You want the share of the option to go below the strike price before the expiration date, or again, your put will expire worthless. Now, the little squares on the right-hand side here, those are the premium prices. Remember how I said earlier that options, you're trading the right to buy or sell 100 shares of a certain stock? Now, that premium price is per each stock. So if you look here and I want to buy one of these option contracts, you'll see that the actual amount of money that I have to spend is $970 to buy that. For a cheaper stock, it will be cheaper. If you make something that's a little bit more risky, it will be cheaper. This has a fairly good chance of netting you profit, so it's more expensive, right? And that price there, that $970, that is the premium price. Now, the premium price will go up or down. You want your premium price to go up because then you can sell your option and you'll make profit. So right now I could buy this for $970 a share, so for $970. If Apple goes down because this is a put, I'll see that the premium price will go up. And if the premium price goes up, then this thing that I bought for $970 could now be worth $1,200, and I'll be able to take all that as profit. Now, also to keep in mind, where it says max cost, if for whatever reason Apple goes up and by the expiration date of March 6th for this particular option here is above $275, the share price is above the $275 strike price, then this max cost, the premium price will go to zero, and I will have lost everything. So your max risk when you're trading one of these options is whatever money you put in there. So in this case, if I bought one of these contracts and expired worthless, the max amount of money that I could lose is $970. Now, of course, the maximum gain is unlimited. Apple could go all the way down to $0 and I could ride that all the way out before March 6th, and you could see that $970 going up to something like, so you'd see it go up to like $100 maybe, I don't know. It could go really high, and this is where you can get some crazy returns on options and stuff like that. So for an example of how I would trade an option here, I can see Apple here, and now I could say, okay, so Apple's been doing really good recently. They haven't because of the coronavirus, but let's just say I'm expecting Apple to go up to $300 pretty soon here, okay? I'm expecting the share price of Apple to hit $300. Now I could trade options, and I'm expecting Apple to maybe go to $300 by let's say March 13th. That'd be a crazy move, but for this scenario, let's just say that I'm expecting Apple to be at $300 by March 13th. Now, in order to give myself a little bit of room for error in my call, maybe I'll buy it for March 27th. That way, I won't be screwed. And since I'm expecting the price to go up, I'm going to be buying a call. So I'm expecting to go to $300, so I'll go up and I'll look for the $300 strike price call on the expiration date of March 27th for a premium right now that's at $485. So I will click on that. Get out of here, notifications. I'll click on that, and you'll see that I want to buy one of these. And since the premium price is $485 per share, and when you're buying a contract for an option, that's for 100 shares. So you're going to take the premium price, multiply 100, and that's the max cost for that trade. Also your max risk. And I can click review. It says not enough buying power because I don't have that much money in this account. But you'll click review, and it'll just slide up, and boom, you'll have that option. Okay, so in review, the share price is the current price of the stock that you're trading. The strike price for a call, you're going to be able to buy shares of that stock for that strike price, no matter how much higher the share price is than it, giving you that profit. So you could buy it for like $300, but the share price would be at like $320. So then you're just getting it for a $20 discount, right? For a put, you want the strike price is what you're saying that you want to sell the stock at. You have the right to sell the stock at for $300, but the stock's down at $280. Then you're being able to sell it for $20 more than it's worth, giving you that much more profit. The expiration date is how long you have to get the share price past the strike price for a call above it, for a put below it, by the expiration date. If that happens, then your money, you're making cash. If it doesn't happen, your option will expire worthless and you will lose money. The premium price is how much that you're paying for the option times 100, and that is also your maximum risk. You want to see the premium price go up because you can sell options before the expiration date and just cash the profit. Just because you're buying an option doesn't mean you have to ride it all the way through to the expiration date and end up having to buy those shares or selling those shares. Like, literally, I have never done that. When I'm trading options, I'll keep an option for maybe a week or two, and I'll see that it's going up, it'll get to a good level, and I'll say, okay, I've made a good enough amount of profit on this. I'm not going to risk it possibly declining in value. So I'll sell it now and take those profits. Okay, the last thing to pay attention to with options are the infamous Greeks. Now, I think a lot of option traders don't really understand the Greeks, but they're pretty important to at least pay attention to, and will help you to understand whether or not the options you're buying are good bets or not. So just looking at this random space option here, this $27 call, if you click on it and you go to where it says bid or ask and click on the bid or ask here, and you scroll down, you'll see this thing that says the Greeks. And the Greeks are delta, gamma, theta, vega, and rho. Delta, theta, and vega are kind of the three bigger ones. Delta tells you how much you would expect the premium of the option to go up or down given a dollar change in the stock's share price. So for this option here, the delta is 0.5053. So if space went up by $1, I would expect the premium to go up by 50 cents. The gamma is just pretty much like how much is the derivative of the delta. So if it goes up $1, then the next delta should go up by 0.04 cents. And if it goes up $1, then delta will change to 0.54. That's less important to really look at. Delta changes the closer you are to being in the money, the delta will be up higher. As you're kind of going in, and it's deeper in the money, it'll eventually start trading dollar for dollar with the stock. But getting that deep in the money that's like deep in the money. A 50 cent delta means that it's pretty much right on the share price, and it will go lesser if it's deeper out of the money towards zero. The theta, also known the time decay of the option, tells you how much the option or the premium will change depending each day closer to the expiration date. So the theta here is negative 0.1383. So if the stock price didn't move at all during that day, and the day passed and the new day came, you'd expect the premium price to go down by 13 cents here. This is because as you're getting closer to the expiration date, the likelihood of the option expiring in the money is becoming less and less likely. Vega tells you how much the option will respond to implied volatility. Right now, the implied volatility, it says it kind of like higher up here, is 195.54%. That is relatively high, so you'll see that options are going to be more expensive than usual. The more implied volatility, the more expensive options will be, because they can move around a lot, the share price can move around a lot, and you can end up going in and out of the money more rapidly. And if implied volatility goes down, options will be cheaper. So that's pretty much the basics of the Greeks. Again, I'll make another video at some other point going deeper into them. But for now, just kind of be conscientious of them, and you'll honestly be more educated than a lot of traders. Yeah. All right, so moving on to my $100 to $10,000 challenge. Today is Saturday, so I wasn't actually able to make the trades, and I made this explanation part of the video yesterday, but I decided it was kind of a poor explanation of things, and I didn't really think it out that much. So I redid it today, and I traded I started the challenge yesterday, and I opened up some positions. I ended up buying a Snapchat $12 put for March 13th, a Peloton $20 put for March 13th, and GE $9.50 put for March 13th, and an Aurora Cannabis $1 put for March 13th. So because I have such a low amount in this, since $100 is a pretty low amount to get started with options, especially with the market being so volatile and options being pretty expensive, I wanted to do a spread strategy to just kind of get myself started so I could build up some more capital to get into these bigger options investments. Unfortunately, Robinhood doesn't let you do option spread trading until you have more options experience on Robinhood, which doesn't really make sense to me because spreads kind of limit your risk, but they also limit your profit, and they're just like a lot more easy to manage, I would say. So it doesn't really make that much sense to me. And again, I'll make a video explaining spreads later, but I'm going to have to unlock it in this account first. So basically, I just kind of went with these pretty cheap options in order to just kind of, in order to unlock it, which I'm kind of disappointed by because they're not really the best options for options in the world, especially with such a low account. But anyways, the reason that I bought my Snapchat $12 put is because the coronavirus, it's been really it's been really screwing up the market lately, and we've been in correction territory, and I don't think that everybody says that like all this coronavirus stuff is priced in, but I really don't think that's true. And especially this weekend, it's starting to look way worse in the United States and in Europe. And once people start realizing that the U.S. and all these big countries, once people start realizing that this isn't just a China problem, I think that the stocks will drop a lot more. And also, like, we were on one of the longest bull runs in history leading up to this. So there's just a lot of reason for the market to go down right now. So Snapchat doesn't really have much going on for it. Snapchat right now is trading at $14.36. So I bought a $12 put because it doesn't really have much going on to it. So I feel like it's just kind of going to travel with the market, and I feel like it'll go down. And a $12 put for 2 weeks out from now, I decided to be a pretty safe bet on Snapchat, since I don't see any reason for Snapchat to go up right now at all. Snapchat is kind of dying, I would say, and because I don't really think anybody really looks at those stories that much. Is just this Snapchat one is probably one of my safer bets that I opened here. Same thing with Peloton. Everybody's been kind of hating on Peloton, and also I just feel like the whole idea is just like stupid. There's also like no reason for Peloton to go up right now, so I also believe it's just going to ride with the market, and I am bearish right now for the market as a whole, so I'm expecting Peloton to just kind of plop down. I bought the $20 put, and they're at $26.86, so they're gonna have to move a lot. But Peloton is pretty volatile, and they went down 7% just on Friday alone, so I'm expecting them to drop pretty heavy with the market here. And if you look at their past month, or their past 3 months, and their past 3 months here, they've been kind of trending down, and you see that they kind of spike up and then drop a lot. And if you look at the past month, they were just on a pretty decent spike for a little bit, so I have a feeling that they're going to drop even further. As for GE, I feel like this is a pretty solid bet. I got the $9.50 put for them. GE is a lot of their future outlook and success of their business in the future is depending on their aviations department, and they make the engines for the Boeing 737 MAX. For the engines for the Boeing 737 MAX, and in January, Boeing posted no aircraft sales with all that bad news with the Boeing 737 crashing and everything, the Boeing 737 MAX. So GE is probably going to get kind of screwed over with their aviations department, and since people were kind of looking forward to the success of the GE aviations, and it's just kind of turning around on them for that, I'm expecting it to go down. And on top of that, with the coronavirus, nobody's really traveling right now. Airlines are shutting down a lot of major flights from China and around a lot of other different places in the world to prevent the spread of coronavirus. So GE is just kind of got like no one to sell to right now, so they're obviously going to be losing a lot of money with this coronavirus and stuff. So I'm expecting them to rocket down a bit here. And for Aurora Cannabis, I bought the $1 put. They're at $1.38 right now, and they've been trending down for the past year, like pretty heavy. They spiked. All marijuana stocks spiked crazy at the beginning of last year in the springtime, early summer, and they've all been kind of trending down recently. And Aurora Cannabis has like got a big cash flow problem. They recently changed CEOs. Nothing's really looking too good for Aurora Cannabis, so I'm just expecting them to just kind of trend down a little bit. And, well, those are the reasons for my 4 decisions there. I'm gonna have to find out how smart or how wise of decisions they are for sure on Monday, but I'm feeling pretty confident for them. So I guess we'll know for sure on Monday. And the market kind of spiked up a bit at the end of Friday, so I ended up down $18. But like this just shows you that how like options are like more volatile than stocks. Like here, this is a 16% difference, but it can just as easily go in a different way. And that's a thing to really pay attention to when you're trading options. You don't want to get emotional because if for whatever reason the market just goes in the opposite direction than you're expecting it to at like a random point of the day, you can be like, oh crap, I'm losing all my stuff. But if you have a good smart reason for going out, buying opening a certain position, just stick to it, trust your brain, make sure you don't get emotional and just panic sell. And we're going to see, I feel like that down 16% might turn into a positive 16% on Monday, but I guess there's only one way to find out, and that's to wait for Monday. And I guess that's when I'll make the next video. Thank you for watching. Again, make sure you download Robinhood. If you don't have it yet, I'll leave the link down in the description. Click that. We'll both get a free stock. Who doesn't love free money? I love free money. I hope you love free money. If not, you're probably weird or on something. And subscribe, like, leave a comment, maybe down below. Let me know what your options plays are, or whatever plays you're making in the market, and get a little community going here. Get some teamwork going. Figure out and just get those tendies, you know? Anyways, thanks for watching. Like, comment, subscribe. Later, Gators.